coming out. And does anyone have any topic that they'd like to raise or go back to something? Yes.
Well, this is a question, if Terry or somebody can answer it, about these GMWBs. Just a simple question. How can they guarantee a certain percentage of return on the money if the markets are all crazy? I don't know. If you have any general comment on how they work, I guess.
I'm going to tackle that because I don't do it, right? So I will say everything very simplistic because it's the way I understand it, but I know it to be true. First of all, the 5% guarantee is 5% simple. That's the first thing to note. Remember, if you're talking to somebody about 5% compound rate of return, that's a whole different animal than 5% simple. Simple means if you've got $100, it means it's going to pay $5 every single year. That's what that means. Compound means 100, then it's 105, and then it's about 112, and then you've got compound. So that's the first thing. So when you look at 5% simple, what does that really mean in a compound world? Less than 3 on a compound world, would you say, depending on how far out you go. The further out you go, the less percentage it is. So how does this whole thing work? Well, you pay a fee in order to have the guarantee. So if you put $100,000 in a guaranteed minimum withdrawal benefit, typically, if it was a mutual fund, you may have a fee of 2.25%, let's say. If you add the GMWB rider or buy a GMWB product, the MER goes up. And typically, was it
3 1/4, 3
about
1/2?
3 1/4. So it's about another point. So if you're in the TSX and the TSX gets 7% rate of return, and typically the mutual fund has, let's say 2% MER, and what did I say it got? 10? 7. Then you got 5, okay, because of the MER. Well, if you've got a guaranteed minimum withdrawal benefit, you actually aren't going to get that full amount. You're going to get a percentage point less. So that's kind of over here. And the carriers or whoever has the GMWBs, will track that. Then they've got another part over here that says, okay, we'll guarantee that there's enough money that you can get a 5% guaranteed simple rate of return. If this is higher than this, heaven help you if you ever want to cancel it because you got fees coming out of your yin-yang to do that. If it's the other way around, you won't feel that, but just know you've paid another 1.5% in order for that privilege. Is it right or wrong? Doesn't matter. It's particular situations. But to come across simply and say it's 5% guaranteed rate of return means nothing. Means nothing. It's not that. You have to understand that part of it. Does that help you, Sally?
Yeah,
on that
thanks.
part? Do you have more to say on that?
Maybe I could just add one thing. There's a term called notional in those products as well, a notional value and an actual value. So what the notional value is based off of, the whole product, what it is before I retire, it accumulates in value. And it accumulates based on what the market return does, or a 5%, as Terry said, simple 5% return up to the date that I choose to retire. Now that 5%, what it does is that it's what's called this notional value. It's not actual money. You can't redeem that amount. What they're saying is, if you start at $100,000, I'm going to pretend like it grew at $5,000 every single year until you retire, and I'm going to base your income off this amount. But whatever your actual money is doing is what you own. Okay, so if the value of your money was $100,000, went down to $80,000, you own $80,000. You don't own that notional 5%. What you own is what the market value is. So if you said, I want out, you get whatever your value is, not that notional amount. When you retire, what happens is, it's almost irrelevant with where your account is in terms of value, unless it's higher than that notional amount. If it's higher, they'll base your income on that. If it's lower, that notional amount is where they base your income off of. And again, what they say is, I'm going to pay you 5% for the rest of your life based on wherever you are at this point, whether, again, it's the actual amount or your notional. They actually take money out of your account, so your value is going to drop over time. maybe it's going to go up, but chances are it's not. And the reason that it's not is because there's fees of 3.4, 3.7, 3.9% at times in these products. You're generally not allowed to invest in a lot of equities. It's all bond-type portfolios. And so you're almost guaranteed to lose money in that portfolio. But that's okay because you're also guaranteed to get 5% of whatever that amount was when you retired. And so you get that income for the rest of your life. But if you were to ask them for your money back, you don't get that, again, a value there. You get whatever's left of your actual dollars, which is a declining value. So the benefit to this product is you're going to get 5% for the rest of your life. And can you get more? Yes, mathematically, there is a chance somewhere, but it isn't very high, that you could get more.
How come? Why isn't your money going to run out? I guess that's the part I don't
So,
understand. Your money runs out, what are they paying you?
So if your money runs out,
5%.
yeah, so your money will
Upfront.
generally run out, but if you think about it, if the average life expectancy is 20 years, they expect 20, for every person that's going to outlive that 20 years, somebody's going to die early,
based on that,
and it's
yeah.
there is some death benefit value to it, but really not much. And in the meantime, they're collecting these beautiful fees, and what they're doing with that is they're reinsuring themselves. And so it's a very expensive product. I don't do any myself either. I don't
Is
believe
there an
in it.
ideal candidate for that product?
Listen, I don't want to talk about that because I honestly, I don't believe in the product. I don't like it. Having said that, yeah, maybe there is. It would be the ultra-conservative person that would say, I'm willing to take the risk of not having any capital left, but having 5% for the rest of my life. The danger is 5% today sounds wonderful. In 20 years, when interest rates pick up and inflation has picked up, and we all look at 5% and go, can you believe we actually were concerned about 5%? Look, a GIC is now paying 10%.
Yeah.
You know, what happens then? And I'm locked into this and I have no recourse. And one of the challenges, a lot of people have gone out and sold this product as the be-all and end-all, and we've seen many, many clients that have said, great, I'm going to put all my money in this.
Yeah.
And so now you've got nothing but a notional value and a payout of 5% based on today's values, not tomorrow's values.
And the truth is, aren't the new ones actually like 3.5?
Yeah, they're even worse.
They're
Yeah.
worse.
They're even worse. The fees are higher, they're more restrictive, and they're even lower payouts. So.
The fees aren't even guaranteed in a lot of these contracts, so what happens is even if the fee starts at 3.25 or 3.5, contractually, what some of these companies have done now is they've actually jacked the fees after people have actually entered
Yeah.
into the contract. So you could be into a situation where your 5% is completely, technically eaten up by the fees alone. And in the fine print, it's clearly stated that they could do
I did
that.
say read the prospectus, but it's hard to understand.
It's
that
really
perspective.
tough, but this is one of those, like, it is too good to be true, and it was marketed like crazy, but again, most people shouldn't be in it.
I want to just go on to one other topic because I had an interesting conversation before we started this panel today, and it's in regards to stocks. Just because a stock has done well, is it something that we should look at, or a mutual fund has done well, is it something that we look at forward? So Adam and I had a great conversation, didn't we, today? And we talked about, was it your grade 10 class?
Grade 9.
Grade 9. You want to tell us about what happened?
Sure. In grade 9, our teacher found a stock simulator online where we were given, I think it was $100,000 of virtual money. And we had to buy shares with it, and we made into a bit of a competition. And whichever kid could make the most money by the end of the year got, I don't remember what it was, some sort of, I think it was a gift card.
And so why, you said you came in fourth, which is an honorable place to be. Why did the other people get the higher amount?
They invested all their money in Lululemon.
So has anybody seen what's happened to Lulu lately? See-through pants, it'll do it to you every time.
Any other topics? Yes.
We've heard the reasons why we need a financial advisor and why we need to have someone we feel comfortable with. Can the panel give some advice on how to go about finding an advisor that you feel comfortable with?
It's a great question.
Other than the obvious, come see us after.
A great place to start is ask your colleagues and your peers who are in, if you're, a lot of you are medical professionals of some kind.
Oh my God.
Ask your
Just a
peers.
second. That's how those Ponzi schemes get started.
But get a few referrals for each person.
Yeah, I think you have to get a few referrals because, you know, in the medical field especially, there's been some wild stuff go on. And I think you have to talk to your accountant and you have to talk with your, you know, insurance advisor. Like I get more calls from people saying, what do you think about this person or this thing or whatever. I may not know the person, but I'll do a Google search to find something and I'll say, you know, probably is a pretty good person that will do stuff. If I know their stuff, I think it's great. But if I find that, you know, I've had experience with that kind of person, I would say no. Like, for example, Paul Manders is in the room. Paul, Doug Mahan, you know, work with them all the time. Helena, these two, Sean. I mean, these are people that, you know, if you came to me and you said, what do you think? I would say, absolutely, these people know what they're doing. And I know them, and I'd be able to work with them because they believe in the process of working together. If I don't know them, I would even pick up the phone and call them and say, you know, what's your plans, what's your thoughts, and all that sort of stuff. And if they're concerned about me, then it's a problem. And you may even think, too, that we may be at odds against each other. For example, Lynn and I worked together when you were in the investment advisory world. We worked together. I'd pick up the phone anytime. And perhaps there were times where perhaps we were in competition, but say to me, you just do it. It was very rare, and you worked together professionally. But you work together, and I think that that's really what you want to find out and really speak to your other advisors about it as well.
How important do you think that personality fit is with your advisor? You're telling them a lot of personal stuff.
Oh, it's huge. I mean, this is the person that often, it's funny actually, the advisor is often the one that gets the first call when you're going through the divorce or you've had a situation where your business is maybe going sideways or whatever. I mean, there's so much personal relationship, and as time goes on for all of us, just collectively, I mean, it's not a client relationship anymore. You really move into that, you become friends, and some people even become, you know, family through that process. And I know for all of us, we all know each other well in the room, we're advisors. I mean, that's just the mindset that we just kind of have for all the relationships that you're fortunate to have. And make no mistake about it, like for anybody that gets the privilege of being one of your trusted advisors, that's the way they feel, hopefully, about how they get the chance and opportunity to work with you. And it's not taken lightly. So as you go along, it's a huge thing that you fit the right way, and that person's got your best interests at heart.
Yes.
What's the difference between a financial planner and an advisor?
Well, you know, most, if I can speak to that, we may not all have the same take on that because there's nothing official, but I would say a financial planner is normally a generalist who is looking over, perhaps as Jennifer led into it, you know, for retirement, for example, are you on track to be independent one day? Have you got your estate plan in order? And train to recognize the situations that require a specialist, whether it's estate or insurance or an investment specialist to come into the mix. So I would say that's probably the thing. And an investment advisor, did you say advisor? Financial advisor often goes more with an investment focus, although not necessarily. So you need to clarify with the person what exactly their role is.
I want to know, when do I need a planner and when do I need an advisor?
And you know what? Truthfully, the terms are used somewhat interchangeably. And you just have to ask, you know, your financial advisor, are you a planner? I never called myself a financial planner, and I told you why initially, until one day, after about 15 years of relationship, a client came in and asked me, do I need a financial planner? I nearly fell off my chair, because I'd been doing financial planning for 15 years with that client. But I called myself, my official title was financial consultant. So you really need to talk with your advisor to understand exactly what their role is and what their qualifications are with respect to that. The term financial consultant and financial planner and advisor are used quite interchangeably.
Sorry, I was going to just kind of jump in on one other point over there. Often the planner might kind of, and again, this is not a universal fact, but they often will look at the big picture of your life. So they will, as Jen said, kind of, in some ways, quarterback, and they'll look at your tax, your legal, your accounting, your portfolio, what's your planning, and all those things like that. So they're looking at your whole big picture. And if you're the kind of investor or person that says, I've got a really great accountant, I'm really comfortable with my tax plan, and I've got a fantastic legal and estate plan over there, then that planner won't be so necessarily needed for those aspects, but you may need very specific portfolio advice, so they'll lean towards that. So if we were going to try and put people in a box, the planner might be a little bit more holistic, whereas the investment advisor or financial advisor, if we're going towards the investment, is more focused on your investment portfolio.
And I have a point. Sometimes your investment advisor can be your financial planner at the same time. So it just depends on how they set their practice up and where they've decided to focus their expertise. So really, basically, if you have something in your hand that lays out where you're at right now and provides some sort of a roadmap in the future, whether it's retirement roadmap, estate planning, and so on, you've got a financial plan, whether that was done by your financial planner, accountant, insurance advisor, investment advisor, whatever. It really depends on how that person set their practice up and what they want to focus on.
Good question. I think the industry needs to address that. Yes.
Yes, a question. When does it make sense, what are the implications of buying investments within your corporation versus personal?
Well, yeah, sure. Well, Vic spoke about dividends versus salary. So the question is whether do I take it out of my corporation by paying myself a salary to then put it into an RSP, or do I pay myself dividends and leave the excess of my corporation and invest it? So if you're going to leave it in your corporation and invest it, one of the big advantages to doing that is the ability, obviously, to pay less taxes. As I'm only paying the corporate taxes, I don't have to pay any personal taxes in taking it out. So on a small business, it'd be 15.5% on the first $500,000. So the ability to have a greater after-tax dollar that you're investing in the corporation is why you would do that. So that's point number one. Point number two, how do you do it? What do you look for in terms of investment opportunities? Well, one of the things we said quite often as a panel here is to be tax efficient. And how can you be tax efficient? Well, one of the things is if you have an RSP and you have a corporation, you have more choice. If you just have in corporate investments, then you have less choice in terms of how to be tax efficient, but there's still opportunities for you. But I give you the example of if I were to have dividend income in my corporation, so if I bought a security as an investment vehicle within my corporation, and that security paid a dividend, well, the taxes on the dividend are actually really high unless I pay myself a dividend out. And so there is what's called RDTOH. I mean, it's a very complicated methodology that CRA has put in place to say there shouldn't be a disadvantage to you in a corporation versus an individual, nor should there be an incentive. There should be a level playing field. So if you had dividends in a corporation and paid it out, you're effectively not paying any taxes on that dividend in your corporation. You're just paying for it personally. And so what we look for in a corporation when we're looking at investments is you should look for things that are not interest bearing. So you don't want to be holding necessarily bonds in your corporation because they're 100% taxable. Taxes are around 49% in your corporation. So instead you want to hold things like stocks. You want to hold things like preferred shares in your corporation, things that pay out a dividend because it's much more tax efficient for you as you're continuing to invest and grow your assets. At some point, you're paying yourself dividends, and as you pay out those dividends, you're normalizing the tax effect of those things. So I think from a security standpoint, that's what we look for. We're always looking for that tax efficiency within your corporation. But having said that, if I go back to my first point, which was your risk tolerance and your asset allocation, I had a good friend of mine who was an investment manager, and he said, never let the tax tail wave the investment dog. And I believe in that too. The number one thing that you should be doing is make sure that you have the appropriate investments first, and then to figure out how to appropriately allocate from a tax perspective. Don't just start with, I want to save taxes. But I don't know if that answers. Does that answer? Yeah.
Good answer.